virtual online offering as well. So we're happy to be here today. Joining me today, we've got Matthew Kim from Signature Investment Advisors, and he's going to be introducing his counterpart there to tell us a little bit more about what's going to happen in the markets. We're going to have a Q&A for the last 15 minutes or so during today's presentation. So we're going to kind of get through some of these slides, and then we'll have a good opportunity for us to sort of chime in and ask some questions. So I want to thank everybody for being here, and we'll get right into it.
Wonderful. Thank you very much, Corey. Appreciate being here, guys. I'll chat a little bit real quick about Signature Investment Advisor, or SIA for short, and then I'll introduce my colleague Darren here in a second. We are an LA-based independent registered investment advisory firm, or RIA. We manage just a bit over $18 billion currently, working with individuals and families predominantly. We've been managing since 1996 as a firm, and we have 5 offices now across the U.S., so we're growing. Primarily based in model portfolios that are diversified, as well as custom portfolios based on our clients' objectives and needs. So I also have the honor to introduce my colleague here. Darren McCoy is our Chief Investment Officer. He's also a Chartered Financial Analyst, or CFA, and a Certified Financial Planner, CFP. So a lot of certifications. I think there's a few I missed, but those are the 2 big ones here. So I'll turn it over to Darren.
Great. Thanks a lot. Thanks for having us.
Thank you, Darren. Yeah.
Thank you, guys. Thanks for coming. We're going to talk today about the investment landscape, kind of what's going on in the world, what's going on in the U.S. We try to put some pictures to the themes that are going on. I think you're going to remember a picture maybe 3 months, 6 months from now instead of an economic data point. So we'll try to tell a story and we'll try to put it into pictures. We're calling this year Safer Bridges. So we'll kind of get into that in a minute. This is what everyone wants to talk about. The debt ceiling on the right, we have artificial intelligence top and kind of what's going on in the banking mini crisis that we have going on. But these items or these events are really an offshoot of what's going on kind of behind the picture. So let's jump one more slide. If we take the last couple of years, you can kind of see where we're going to go to next is really dependent on where we've come from. So the last couple of years, 2020 really dictates 2021, which dictates 2022, and which we think will dictate 23 and 24. So if we start at the top left, we can all start with the pandemic. And the amount of stimulus that was thrown into the system, just the amount of cash that was thrown into the system, both from the fiscal side and the monetary side, was just apples and oranges compared to anything that we've seen before. It was 4 or 5x what we did in 2008. And so all of that stimulus spending put a bunch of cash into the system. It helped us get us through a global lockdown, but it also created this environment where there was just a lot of froth, just too much cash into the system. So in the yellow here, this kind of leads into why the banking issue is coming to a head nowadays. It's really because of the pandemic. The pandemic kind of caused Silicon Valley Bank to go under. So all of this cash in the system has to get deposited into the banks. And then those banks in late 20 and 2021 need to do something with that money, right? So they can make loans, but most of it went to investments. The good thing is they didn't do the same mistake as they did in 2008. They didn't buy risky stuff in terms of, am I going to get my money back? What they did, they bought safe stuff. But if you know fixed income, there's 2 types of risks. There's credit risk, bankruptcy risk, but there's also interest rate and duration risk. So the safe stuff that they bought had a lot of interest rate risk and duration risk, and that was when interest rates were at 0 or 1%. Now fast forward, all of this stimulus spending has now kind of dictated the debt ceiling crisis that we have here on the left. But as we move through and then now back up that middle column, we're getting into the part of the cycle where all of that money is causing kind of angst in the global marketplace. So some of the money went to Dogecoin and those kind of assets. Some of the money went to some meme stocks and the craziness we saw with GameStop and AMC. But there was just too much money in the system, supply and demand, that led to inflation. So now going up this column here, that inflation changes everything. So monetary policy had to change, fiscal policy had to change. You might remember Manchin and Sinema cutting back on fiscal spending at the end of 2021. And then you had Jerome Powell starting to raise rates in March of 2022. It wasn't that long ago, really. And so now we have tighter monetary policy and higher interest rates. When rates go up, bond prices go down. So now all of these investments that the banks made now just went south. And a lot of investors saw that in their own bond portfolio in 2022. Well, that happened at the banks as well. So now they're sitting on a bunch of unrealized losses in their investment account. So now we're at the top of this middle column. Now we're at rates at 4 and 5%. So we can go buy a T-bill at 500 basis points, but Wells Fargo is still only paying us 50 basis points, 0.5% on our savings. So guess what we all do? We leave. We're taking money out of the banks and investing it into somewhere else. Maybe money markets at Schwab or Fidelity, maybe a T-bill at the Treasury. So now the banks need to give back the money to the depositors that are fleeing. So now they need to sell their investments. So all those unrealized losses turn into realized losses, and then that turns into insolvency. So now coming down, we're now at the back end of this whole cycle that really started in February of 2020 with coronavirus and the pandemic and COVID-19. So now we're seeing the kind of the tail end of that. What are the ramifications? What are the shrapnel of this higher, tighter monetary policy, higher inflation, higher interest rates? It's slower economic activity. And we kind of saw this back in 2021. This was the picture we were using back then. We were coming out of the pandemic. We were hoping to go back down the left side of this fork, getting back to normal. But we were concerned in the investment committee that we were going down the right side of this path into an over-caffeinated, over-inflated economy where there was just too much money chasing too few goods. And then we saw that with everything from furniture to cars to wages and everything else around the globe. So unfortunately, we're in this overstimulated, over-caffeinated economy, which has its own problems as well. And so we thought because of this overheated economy that we'd just see chop in the stock market. And this is kind of a confusing chart, but if you focus on the gray, that's the S&P 500. And you can see since that time period when we had this chart, that picture show up, we've been up and down, green, red arrows all the way through, so much so that we're now at the same level in May of 2023 that we were in May of 2022, which was the same level as May of 2021. It's just, believe it or not, we're flat for the last 2 years. Just a bunch of chop here and there. So that's kind of where we've come from. And I'm trying to illustrate that one landscape leads to the next, which leads to the next. So now what's going to happen next? What happened next in the economy is because of what has already happened. So with this higher interest rate environment, we think slower economic activity might be in the next few months, if not the next few quarters. So what's the picture for this year? Well, in 2022, we were talking about twin hurricanes. One hurricane in the bond market, one hurricane in the stock market, maybe 3 hurricanes, with one potentially coming in the economic activity. But I didn't really like that picture because if you're in the middle of 3 hurricanes, there's really nowhere to go. There's nothing to do, but that's not true nowadays in this landscape. So what we kind of pivoted towards were safer bridges. I think that's a better analogy of what investors face this year. So what we have here on the left side of that picture is the U.S. stock bridge. And in that blue circle are all of us, investors in the marketplace. And you can see we're traveling down this bridge. It does make it to the other side of the river, which is great, right? It doesn't just end. So this is not a calamitous event, but you can also see it's kind of rusty, it's kind of rickety, and there's not a lot of guardrails, there's not a lot of safety on this bridge. So there's pitfalls everywhere. And we can kind of see that with the artificial intelligence trade right now. If you strip out those groups of stocks, so let's say 10 stocks in the S&P 500, If you strip out the 10, the S&P 490 is flat year to date. It's not even up. So there's pitfalls in commercial real estate and office and banks and retail and there's a lot of risks to this bridge. We're halfway across the bridge. The risks of 2022, I think, are behind us. That's inflation and higher interest rates. I don't think we need to worry about that anymore. But the risks ahead of us, next slide, is that if you can see it, there's the recession and slower economic growth. Those are the risks that we need to navigate the next 12 months or so. So in investment parlance, you might hear that the risk to reward is not great. It's not the best time to push all the chips in on the table for the US stock bridge. Again, I think we make it to the other side of the river, but the risk to reward is not as good as it can be. So before we get it to the recession, I just want to drive a point home that the last year's risks are truly in the rearview mirror. So that's inflation. So if you can see this, the April of 2023 inflation is 4.96. That's the same number all the way across the table. We think inflation is going down. We thought this back in December when inflation was in the sixes. Yeah, it's still elevated, but it's going in the right direction. We think it will continue to go down for a couple of reasons. One is because it's just math. Inflation is an annual figure, but what it really is an aggregate of 12 monthly figures. So for the last 5 or 6 months, those monthly figures, M/M, month over month, has been anywhere between 0 and 0.5% month over month. Now, a 0.5% month over month is high. If you multiply that by 12 months in the year, that's roughly 6. It's a little bit higher because of compounding. But even if we take worst case scenario of what we've seen of 0.5% month over month, if we add that in May and in June and July, that's a high figure, but we're taking off a much higher figure from May, June, and July of 2022. So it's just math. If we add a 0.5%, inflation is going to be in the threes by the end of this quarter. And we don't even think it'll be 0.5. We'll think it'll be something more like 0.3. So we'll be in the low threes by the end of this quarter, if not July. Because again, it's just math. Maybe inflation is something we have to worry about in 2024 if we get kind of an echo type of thing that happened in the 70s. But we can worry about that later. We don't need to worry about that now. The second reason, besides it's just math, is because if you look at the subcomponents of CPI, the vast majority is from, it's called owner's equivalence rents. They don't measure how much our homes are worth, but they measure how much it would cost to rent our homes. And so that just took off and went through the roof during COVID. But now that's starting to roll over here. This is government data. And that owner equivalence rents is about 40% of the index. So it's a big, big number and a big, high elevated print. So that's driving the bulk of the inflation. But the US government isn't the best macro hedge fund trader. They look at data that is very, very lagged. So if you look at real-time data from something like a Zillow, you can see that rents have already rolled over hard and are actually now in negative territory. So month over month, it's just math. Inflation's going into the threes. When the government data kind of catches up to real-time data, it could even go lower than that. So inflation's in the rearview mirror. What else drives markets is growth. And so that's the real issue that we're worried about the rest of this year. So when you have higher interest rates, that's really just the cost of money. And so anything tied to a loan, that's the part of the economy that gets affected first because the cost of it becomes so much higher. So we've seen it in housing now. Housing starts are down 10 months in a row. Housing prices are kind of coming off the boil. Everyone has a lower mortgage rate and unrealized gain in their home. So there's not a lot of movement around the country right now because people have to sell, get a higher mortgage rate and pay a cap gain on their home maybe. So home improvement activity is kind of coming off a boil, especially because everyone redid their backyard in COVID and bought new couches and all that. So we're seeing it in housing first. and then that's kind of bleeding on to the rest of the economy. So this is industrial production. Percentage off its 52-week high in the top right. You can see here we're down now to this red horizontal line. And hopefully you can see this, but I'll refer to this a couple of times throughout the presentation, is when we're at these types of levels, it always predates a period that is marked by a gray bar, and those gray bars are recessions. So when we get to these levels, it kind of predates those gray bar recessions. It's a forward-leading indicator. It's predicting recession. And then you can see probability of recession, the bottom left. When we're at these levels, the probability of a recession in the next 6, 12, and 24 months in dark blue is much higher than it is in light blue. So right now, the next year, we're at around a 71% probability of a recession. Now, I know you're not going to be able to read this, but this is economic data, just a lot of the subcomponents going back to 2021. And don't focus on the metric or the actual number, just focus on the color. You can see we were worried about a slowdown or recessions kind of in the middle of the chart when there was some green and some pink. But now we're at the far right of that chart where there's a lot of pink and a whole lot of red. So the economic data that we were worried about a year ago is really starting to get worse here in the last few months. So the weakness is starting to be persistent. It's starting to be pervasive. It's kind of spreading through the economy away from housing. And it's also into manufacturing. So this is a mouthful, but it's the ISM Manufacturing Index. And you can see it goes up and down. There's periods of growth. There's periods of contraction. Everything above 50 is expansion. And you can see we're below 50 at 47.1. So what I tried to do here is take out a lot of the noise. So I shaded out the top. And here, when we're at this red line here, we're again at periods that usually predate that gray bar recession. So since 1950, there's been 16 times when we've been at these levels. 12 of 16 of those have led to a recession, and 4 of those haven't. So there's been, 3 of those have been soft landings and not a recession. So that's what you'll see on CNBC or the Journal or whatever, is that hope that this time is a soft landing. We kind of got a soft landing in 2016. We got a soft landing in that 94, 95 period, and then way back in prior cycles. So that's the hope. But what's happened here lately? Well, now we're back to the banking crisis. So what we have here is that same index, manufacturing, but I overlaid it here with the red line, which is what percentage of banks are tightening credit. So you can think of it this way. When there's risk out there and you might not get the money back on a mortgage for the person's third home in the suburbs of Vegas, and it's a 98% loan to value mortgage. You know, when there's risk out there, you kind of start to pull in lending standards. Maybe you raise FICO score requirements, or you raise loan to value requirements. So are banks lending money? Are they becoming tighter with their capital standards? So that red line is on the right hand scale, but that scale is inverted. So when the line is near the bottom, a higher percentage of banks are tightening credit quality. There's less credit in the system because they're not loaning out as much money. It's harder to get a mortgage. It's harder to get a loan. And when you overlay that with the blue, you can see that when we're at levels right now like we've been in the past, that's usually predated those gray bar recessions. But if we go to, one more. When we go, these are supposed to be green, but it's not coming through. But if you see those circles, those aren't gray bar recessions, those are green bar soft patches. So when you see these green circles and we get a soft patch, what's going on? Manufacturing's down, but what's going on with bank lending? It's still loose. Banks are still lending money. We're not seeing that today. So we have the down cycle in economic growth, and we have Silicon Valley Bank and the banks kind of tightening up and getting safer and not lending money. So there's less credit into the system. So we don't think we're going to see that soft landing. We're going to see more of a recessionary or at least economic weakness type of scenario. And a lot of this data is even before Silicon Valley Bank. So you can roll all of these data points into kind of an aggregate metric. This is one from Clearbridge and Franklin, and it shows where are we in wage growth and new orders and profit margins and truck shipments. And you can see they give a red tick or a green tick, and we kind of compare it to past recessions. I grayed out the pandemic because that wasn't really an economic cycle. And you can see here, in past recessions, they're not always necessarily all red. There's some yellows in there. But we're kind of in that area now where the overall signal at the bottom left here is a recession. This is from a third party, so if you don't believe us, this is a different group. The one area that they point to that is still a good part of the economy is jobs. And that makes a lot of sense. How can you have a recession if everyone's still working and there's a bunch of money going around? And that's true. We need to see kind of some weakness in the job market before we can have a clear call on the recession. And one more group out there, this is Strategas. You might not have heard of them, but they do a great job on the research side. They have a lot of red check marks, except for jobs. So now we need to really focus on the job market. So this is real new news. So this is just in the last couple of weeks, last couple of months. What we have here is the last 12 months of unemployment claims, initial claims. They're in light blue. And you can see that on the far right of the chart, it has just broken out of its range that we've seen here for the last couple of months. So it's trending higher. And we overlay that with the dark blue, which is the averages of all of these claims before recession. So the trend in initial claims is trending just like it has in prior recessions. And other models, this kind of gets into the weeds, but this is a model from the Kansas City Fed in red, along with the official unemployment rate in blue. And you can see in past cycles that the red kind of leads the blue. The Kansas City Fed now, bottom right, it's kind of like this, right? The Kansas City Fed is predicting a higher unemployment rate here in the months and quarters ahead. So that one green part of the market, jobless claims, looks like it's starting to weaken here lately. And you can measure it a couple different ways. Layoffs are trending higher, that's top left. Hiring, top right, is trending lower. Quits, you quit your job when times are great. You don't quit your job when times are bad. You're lucky, you're just happy to have a job. So people are quitting less, which means it's a harder job market out there, and job openings are coming down as well. So we're trying to read the tea leaves here and kind of see what's going to come up in the months ahead. So depressing, I know, not the best news. But again, I do think that bridge makes it to the other side of the river. But if you remember that picture, there's more than one bridge. There's some safer bridges out there. And so when we're looking around and looking at this environment, fixed income really looks like a great play here. Bonds. And when you go try to find a nice, fun picture of bonds, that just doesn't exist. And so I brought here the Department of Treasury. That's going to represent bonds today. But I did notice that it was founded in 1789, and I remember the musical Hamilton and Alexander Hamilton forming the Treasury and whatnot. But then if you start looking at the data, the reason why investors have all this angst in the bond market is because last year was the highest increase in Treasury yields here on the far left since before Alexander Hamilton formed the Treasury Department. So since 1788 was the last time Treasury yields rose that high again, predating Alexander Hamilton. So it was the highest move in government bonds in US history. So what happens the year after rates have a year like they just had? Well, in light blue here, most of the light blue is down. So after a period of higher rates, usually you get lower rates. There are 4 or 5 years here, 4 years where interest rates continue to go higher. So let's look at those. 1980, 1978, 79, and 77. So that era was the era of high inflation. So if we think inflation is in the rearview mirror, we then don't believe that these comps are the best for us. We think rates won't continue to go higher. We think it'll be the light blue on the bottom. We think they'll go lower. So what we can do here is buy fixed income, buy bonds at a temporarily high interest rate, because we think rates will go lower, especially if our recession call is right. So again, predating these gray bar recessions, you see interest rates peak and then they move south. So what we can start to do here now is lock in these higher yields. The same thing that you did with your mortgage in 2021 when you were locking in low yields. Now you want to lock in high yields and earn 4 to 6% maybe in terms of yield. And then if we can get a couple percentage points on growth because interest rates are going to go south, now we can kind of start earning the same types of returns that we get in stocks. A safer way to get across the river with a whole lot more guardrails, especially what we think the investment landscape will be in the next couple of months. We can take that one step further. We all know about public bonds we buy and sell. We can get liquid within 3 days. But there's also an asset class out there called private debt or private loans or private credit, where we get to lend money to individuals, to corporations really, and earn more than that 4 to 6% in yields. And so the downside to these types of investments is really built into the name. It's private. It's illiquid. So we know about private equity maybe, where you lock up your money for a certain period of time. This is private debt, where we need to lock up money for a certain period of time. But I'll give you guys kind of two thoughts here. Most of the time here, liquidity is not your friend. So I can be a little bit more nuanced. Most of the time, we don't need 100% of our portfolio to be liquid within the next 3 days. We can take a portion of the portfolio and kind of have it be semi-liquid here on the side. And another reason why liquidity isn't your friend is investments can be emotional. And most investors don't become liquid at the top when things are seemingly great, but valuations are expensive and the forward risk is really, really high. They tend to get liquid down here at the bottom. We all probably know Democrats that sold stocks before Trump got elected. I know Republicans that sold stocks before Obama got elected. They tend to get liquid at the bottom, or even 2008, right? So liquidity sometimes is not your friend. So if we can lock up some money into a vehicle, now we're not earning 6 or 8%, but we're earning 10 or 12% in terms of yield. Again, now we're really starting to earn returns that are much higher than the bond market and rival the historic returns of stocks with a lot of safety built in. So what this is called is private debt, private loans, private credit, middle market lending. It's all different names for the same thing, just to confuse all of us. But what it is not lending money to Apple or Microsoft, not the large caps. They can access the high yield market. Not lending money to Carnival Cruise Line. You know, they're kind of a mid-cap type stock. They can access the high yield market. But it's those middle companies that generate most of the GDP in the U.S. If they stood alone, they'd be the 9th largest country in the world. But they're not big enough to access the high yield market. So they have 50 to 100 million of EBITDA, you know, a pretty sizable company, but just not huge. And so how I explain this to my mom is, if you're a W-2 employee with high credit score, you can get a mortgage relatively cheap, relatively. But if you're K1 or 1099 or less credit quality, you can get a loan, you can get a mortgage, but it's going to cost more. It's not going to be as cheap. So same things with corporations. Apple can access the high yield market for relatively cheap, but those smaller companies can't. So then we step in and we lend them money, and it's not 6 to 8% yields, it's 10 to 12% type yields, with a whole lot of safety because of covenants and low loan to value and whatnot. So this can be an hour seminar in and of itself. So I just kind of scratched the surface, but I wanted to highlight what are some other assets out there that, again, can get us across the river with a lower risk. So we have bonds and loans over there. It's a newer bridge. It's got some guardrails, a whole lot safer. But there's other assets out there as well, and I'm kind of wrapping up here. This is a mouthful, but let me walk you through it. The ACWI ex-US, that's the all-country world index minus the United States. So it's the world except us. NTM, next 12 months. So what are they going to earn in earnings? PE, price to earnings ratio. So what's the world's next 12 months valuation look like compared to the US, relative to the US? You can see here on the left of this chart, international was very expensive at the top of this chart. So think of that as the build out to the 08 Olympics in China, when everyone was just giving China everything they needed to build an airport every other day. Valuations were really high, but then what we had this last cycle was the rise of platform companies, the YouTubes and Facebooks and Apples of the world. Valuations went through the roof, and now we're at the bottom, polar opposite end of this chart, where US valuations are historically wide compared to the rest of the world. So another way to look at this chart is the US is in red. The rest of the world is everything else. On the left side of this chart, this is valuations again. The delta, that blue bracket, used to be a lot more narrow. Valuations used to be a lot tighter a decade ago. Fast forward to the right side of that chart, that blue bracket, that delta is very wide. Valuations in the US are very expensive compared to the rest of the world. So if we think we're going to hit a recession, you want to buy assets that are cheaper. And let's think back to the last maybe 2 recessions ago. Let's go back to maybe the dot-com era. What sold off more? Was it EMC, Sun Microsystems, JDS Uniphase, and Pets.com? Or was it Philip Morris and those types of names? The cheaper names held in a lot better than those higher price names. So we can do this with the globe as well. We can buy lower price stocks overseas. So to kind of put some names to that idea, even the cheap stocks in the US, which are the energy companies, they trade around a 10, 11 PE. You compare that to the same energy companies making the same oil, pumping into the same cars, you can see that they trade at 6. So even the cheap companies in the US are far more expensive than the cheap companies overseas. And oh, by the way, they have the same margins and a little bit higher dividend yield. So we get a lower valuation on the stock, selling a commodity with a higher dividend yield. Now back to the debt crisis. If things get really crazy, which that's not our base case, and the dollar does something really funky, it's nice to have a chunk of assets denominated in other currencies. So we can go buy British Petroleum in pounds. We can go buy these other companies in euros and benefit if the dollar goes south and their currencies go north. So currencies games is a two-way street. If your currency is going down, something else is going up. So this is a chart of the dollar going back to 1975. And you can see that we're at the top of that range. The dollar is really strong. And so just logically thinking about this, going to Europe is more attractive now than it was 5-10 years ago because the euro is at like 108. It used to be 140. The British pound actually hit parity where it used to trade north of 2. So it's a good time to go on vacation in Europe right now because the dollar is strong. We think that would actually roll over and the dollar will weaken in this next cycle because of where we are right now. So if the dollar does weaken, debt ceiling aside, the other currencies would appreciate. So owning assets in Europe, even if the company doesn't do anything, as the euro goes to 108 to 120 to 130 to 140, our investments would just automatically appreciate because we're denominated in those foreign currencies. So again, even if things get really funky here in Washington, D.C., it's nice to have some assets denominated in other currencies. Plus the higher dividend yield, plus the lower valuations. So there's a couple of different bridges here. It's it's not the best outlook for U.S. economic growth, but unlike past cycles, there's options out there nowadays. We can invest in fixed income and earn a decent rate of return. We can invest in private vehicles and earn the returns of stocks, or we can move our assets overseas. I think that's it. So, topic of the day, I think we'll know tonight if this is resolved.
Yep.
We don't have any inside information, so we lean on groups in DC, and we kind of act as a funnel to get a lot of people's different opinions. This is what I've seen at a Strategas, and I'll just give you the highlights here. Bullet one is this is purely political. It's not going to affect the portfolio on a permanent basis. So this is more a decision on how we vote than how we invest. Number two here is in 2013, there were guidelines on what the Fed would do. I guess Bernanke put this out. If 2011 were to happen again, this is what they would do in the future. And they laid out, you're not seeing this in the journal, and I don't know why, but they laid out what they will do in case of a debt ceiling crisis. And so bullet three here, I'll just read it verbatim. Should Congress fail to raise the debt ceiling, the government would have enough money for Social Security, Medicare, defense, and interest. In part because they get cash flows every 2 weeks, and then they're going to get a huge cash flow the middle of June with tax payments. So that stuff will continue to get paid according to this 2013 memo, but everything else would be more like a government shutdown. So I think on the other side of this, worst case scenario, it'll look more like a government shutdown and not a historic default on the debt. We'll all knock on wood for that one, though. But we'll know more. This is kind of an evolving story every few minutes, really. Okay.
Very good. Well, thank you, Darren. That was a lot of really good information, and we appreciate you sharing it with us. We're going to have some questions, so I'm sure you all might have some questions. There's a lot of smart and accomplished people in this room. We got doctors and lawyers and authors here today with us. So I did want to ask one question first, though. You mentioned kind of your mother in our presentation, and kind of how you would explain yields and debt, depending on what side you're on. Looking at the economy today and trying to understand, you made the case that we're heading towards recession, and I think employment is the last rung that we need to probably climb to recession. But looking at where the market is today in terms of performance, and you mentioned that, thank you, there's a couple of stocks in the S&P 500 that have kind of carried the load this year, but then you look at the NASDAQ and certain parts of the market being up. I mean, does it make sense for the Russell 1000 growth, which is the more growth side of the market, to have run up to 20% this year, whereas the Russell 1000 value as of the start of this week actually lost money? So the safer stocks, the dividend-oriented stocks, were down slightly this year, whether the growth stocks are up 20+%. So how does that happen with an impending recession?
Right.
Where is it coming from?
Great question. We try to answer that every week. Yeah. Part of which is I was an old math major, so I go back to my favorite line. It's just math. Growth stocks were so oversold heading into the new year that a lot of the growth that you see, the performance that you see year to date, is just kind of the snapback from that oversold nature in 2022. But part of it is the tech industry is really matured. So in prior cycles, we would have never said, we're heading into recession, let's buy tech. Mm-hmm. But it's such a mission critical asset nowadays. And Microsoft and Adobe and even Apple have changed their revenue stream from buying Office 365 CD to just having it be recurring revenue. That's what you want in a recession, is recurring automatic revenues. And so it's more of a defensive trade this cycle, kind of on par with staples, utilities, and healthcare. than it has been in prior cycles. So a lot of it is what you own, but what you don't want to own is something tied to the consumer where spending might go down. And so you're seeing a lot of pain over there in consumer discretionary.
Right. So it's
Back
tagged
with the
the
cash flow.
Right.
Yeah, yep. Interesting. Anybody else have any thoughts, questions, elaborate? Dan, go ahead.
Yeah, you talk about recession, without getting political, I'm just trying to get an understanding of how do you define recession? There's so many definitions out there. Like, give us your plain definition of a recession.
Recession is generally pain on Main Street. So you can have pain on Wall Street and not have a recession, but when the pain hits Main Street, that's kind of the easy way to think about it, and that really gets tied into jobs. We actually had 2 quarters of negative GDP last year, but there wasn't a lot of pain on Main Street, so it wasn't defined as a recession. But the actual declaration of a recession comes from the National Bureau of Economic Research.
Yeah.
Which it is what it is, but don't rely on them, because back in 2020, they declared a recession when they declared the recession, it had already ended. So by the time they declare a recession, it's probably a great time to invest.
I'm not a math major, but I've been reading about this debt deal and the ceiling and how it's going to shape the global economy. So not just the United States dollar valuation, but how is that going to affect those countries, all the other countries? Will their valuation still go up, or is it?
Great question. Going back to 2011, the bulk of the decline in the stock market came after they came to a deal. So back then it was the Tea Party, if you remember them, and Obama. They came to a deal, but the deal had so much austerity written into it that it tightened financial conditions even more than the market was expecting. So this could, I don't want to be too pessimistic today, because I do think stocks will do well 2-3 years from now. But again, I think we'll have a lot of chop, and it's because of this dynamic. We be careful what you wish for, because if the deal causes financial conditions to get too tight, you might actually have more people selling after the deal than buying after the deal. So that's here in the U.S. And then what happens overseas? Europe benefited a great deal by China reopening. So China consumers, pent-up demand, buying luxury goods from Europe. So Europe had a great quarter. I think England and Germany just posted all-time highs this last couple of weeks, last couple of months. Japan's at a 35-year high. So we think they are cheap, but I think now they have some momentum. So I kind of think that still continues, especially as U.S., the globe only invested in the U.S. for 10 years, really. I think now some of that money is going back home and will continue to support their markets.
Another question? Yeah.
Thank you, Miriam.
Do you see any lingering effects from the supply chain issues? Can we put a period on that, or do you see, some things lingering from that?
Great question, and I don't have that slide in my deck, but I think that's a period. I think supply chain is normalizing, and that will only add to lower inflation, which is great news. Great news for everyone. We don't have to wait a year for a couch or whatever. And then one more point to kind of international stocks. There's a great line from a decade ago. They're so cheap. Buying British Petroleum at a 6 PE, there's a lot of risk that's already built into that. And so the line is, you can't get hurt jumping out of a basement window, right? So a lot of stuff needs to go wrong for that to not work, because it's so cheap. There's not a lot of risk in that type of investment.
Along those lines, if you I mean, so you've got to take all of this data and all this research and work with your team. And by the way, your team you refer to as DIMES, and what does DIMES stand for?
The Department of Investment Management and Economic Research. So that's kind of my group that we're looking at global markets, and our kind of framework. Everything has an acronym, right? We use GISMO. So we're looking at growth, inflation, sentiment. What's the sentiment out there? Is everyone buying Dogecoin, or is everyone miserable? And usually those are contrarian type of indicators. What are the markets telling us? And what are some items that are not market related, and what are they telling us? And so you can look at commodities or assets out there that aren't tied to a stock market. So there's no type of FOMO trade to them. It's just real life what's going on with these markets and industrial production and whatnot. And when you look at those types of markets, they're not painting a rosy picture either. And then we try to get to the O, which is our outlook. And so that's kind of how we're set up and how we look at the world and kind of come to a...
And so you've got
Formulated this perspective that you think, recession and hard landing recession, right? Not mild recession,
Not soft, but...
not soft. And so,
But not 08 either.
but not 08. And
And
so
so-
you've structured your portfolio the way it looks today for that particular outcome. How then do you, if we, labor keeps us out of recession and we never kind of hit that hard landing, how do you then sort of manage through that? What changes do you make to the portfolio?
We are always very vigilant on whether we're wrong or not. And so we can have a view, we can put on a view, but if we're wrong, how do we really unwind that? And that's the great benefit of this cycle. We couldn't say this in 2019. We thought there'd be a slowdown going into 2020 as well. But you couldn't go out and buy 10-year bonds at a 1% because if you were really wrong, the delta was so wide. Nowadays, it's a much easier cycle from an investor standpoint is because if you're wrong, you're still earning returns that rival the other side of the ledger.
Right, yeah.
So with fixed income and international as well. Yep, on that side.
And then if we're right, you materially outperform.
Very good. Very good. Well, any final questions? You used yours up. Just kidding. He gets two. All right. Yeah.
So you're talking about the second bridge. Yes. So when you look at the whole portfolio, like what percentage should you be leaning into that second bridge? Are you saying 100%? Are you saying 50%? Is it situation, based? I mean, how much do you jump onto that second bridge?
Right. You need a North Star for sure. We find that a lot of investors are very heavy US centric and very heavy large cap. And so for them, it's a big delta move to where we would like to be. And so our North Star is just kind of the world. We look at the globe. And the globe is about 55% US, 45% overseas. We think that's a little too aggressive. I don't think we need to go because home country and we don't need to worry about currencies on a daily, weekly basis. We kind of bring that back to more of a 75-25. So we're materially overweight the US versus the globe. And then we even add a little bit to international from there. So that's kind of, say 80, 70, 30 maybe, something like that on the equity side. And then really the introduction of fixed income and safer assets really depends on the planning and the needs of the portfolio. Do we need to generate income to go home every month, every quarter, or do we have a 30-year type of time horizon?
Yeah. To clarify, we're not market timers, and so this isn't us jumping ship from one asset class to the next. It's how we define in terms of our investment committee, where do we want to be overweight within the portfolio and where should be underweight relative to what risks and opportunities are out there.
So kind of a traditional portfolio instead of a 90% US large cap, it might be 40. And then with 30, 40% of fixed income and then the balance overseas.
Last question then, unless anyone has another thought. No. Yeah.
Like we were talking about earlier, we also have a lot of 401ks that we do work with right outside of the individuals that we have in the room here with y'all. Overall themes for them as well, just maybe some diversification, looking at kind of other asset classes like what you talked about, right? I mean, again, it's great if you can pick your own individual stock inside of your portfolio, but again, maybe for the people that are online and again, for those 401k participants that we hope are logged in, again, probably the overall theme would you say is the same, just again, look elsewhere, think about other asset classes than maybe what they've done to the previous years.
The bulk of the gain the last decade was large cap growth. And that's because you had the rise of platform type companies. And by the way, Apple was a 12 PE a decade ago because everyone was fearful that it was going to be the next Motorola. And so then you had that stock go from a 12 to a 24 PE, maybe, and Microsoft now at a 30 PE. So if you're going to stay in those type of assets that won the last 10 years, you need to ask yourself, are we going to have another set of platform companies and are earnings going to double again from here? Most likely the answer to both of those is no. Yeah. So we need to be much more diversified the next 10 years than we have been the last 10 years.
Not too dissimilar from the .com, right? Yeah.
I'll throw those words.
Yeah.
We've only got 5 more minutes and then everyone else will come in.
Yeah. So let's finish up then, Darren. What do you need to see to stop the chop, right? Till we get, realistic sort of movement out of this thing and true recovery in the markets.
So everyone focuses on the P, the price, but there's also the PE, which is the earnings. So as we move along this cycle, if the E can catch up to where the P already is, so as earnings catch up over the next couple of years, we'll finally get back into a more normal type of environment where then maybe on the back end of this cycle, we can have a new business cycle again. And the good news there is the next cycle, it sets up pretty nicely for small caps. And you definitely don't want to own or overweight small caps going into a recession, but coming out of the other side, small caps look amazing. They're very cheap compared to large cap. If we do get a recession and we do get a rise in bankruptcies, well, on the other side of that, high yield markets generating 8 to 12% type yields look amazing as well. So it's kind of melees here for the last 2 years for sure, maybe the next year, but then maybe we do have a roaring 20s as the last 6 years of the cycle, of the decade.
I like the way that sounds.
Yeah.
Yeah. And so will all our guests today. So, yeah. On behalf of all of us, thank you guys for being here. We know you came a long way from Los Angeles to be with us today, and we appreciate it. And thank you for sharing some really good information.